Is right now the best time to be invest, or should we just wait? Okay, so what if you had invested $100,000 in the S&P 500 at literally the worst time ever? Let's say you decided to invest $100,000 in 2008. Your $100,000 dropped a whopping 38.49% and was then worth $61,510. Over the next couple of years, your money will have creeped back up, and finally, in 2013, your money would be worth $125,971. You'd enjoy mostly good years, continuing until about 2022, where we saw a lost total of 19.95%. But then in 2023 and 2024, we had monster years, over 20% gains each. Now, as of 2025, your $100,000 will have grown to $461,797. So literally, you picked the absolute worst time in the past 20 years to invest. Your money went down 40%, but you still ended up at around $500,000. Let's make this clear. You don't need to be a Wall Street genius to invest. You just need to stop trying to predict the next Nvidia and start owning the entire market. That's where index funds and ETFs come in. Think of them as cheat codes for beginners. An index fund is like a shopping cart full of stocks that track a major market index, like the S&P 500. You're not betting on one company, you're betting on the economy itself. Historically, the S&P 500 has returned around 10% a year on average. That means your $100 can double roughly every 7 years without you touching it. An ETF, exchange traded fund, is basically an index fund you can buy and sell like a stock. Some ETFs track specific sectors like tech or renewable energy. Others mimic full markets like the NASDAQ or global indexes. So instead of picking one company to marry, you're dating 500 of them at once. Diversification at its finest. And the best part? Low fees. Most ETFs charge around 0.03% to 0.1% in annual costs, while actively managed funds can take over 1%. That difference compounds massively over decades, and not in your favor if you're paying more. Everyone's waiting for the right time to invest. Spoiler, it doesn't exist. Even the best investors can't time the market. So here's the move. Automate everything. Set up recurring investments every month, no matter what's happening in the market. That's called dollar cost averaging. You buy more when prices drop, less when they rise, but you always stay in the game. The goal isn't to hit a home run. Consistency beats perfection. Because the longer you stay invested, the more compound interest turns into your personal cheat code for wealth. Buying is easy, but holding is where the money's made.